Welcome everyone to the AgView Pitch, the weekly market outlook. I am not Chris Barron or Shay Folk, but I'm Paul Nee for helping out. And to this week's market outlook, we're going to have a conversation with Peter Meyer and Jarod Creed. And Peter, I think we'll start off with you. Well, first, welcome everyone to the podcast. And Peter, we'll start off with. I'm screwing this up already, but I think
you're fine,
Paul. Peter, we had multiple reports come out today, and I think we'll just start off with what your thoughts were on the actual reports, or what you think some of the key takeaways are, and then I'll jump over to Jarod.
Well, I think that everybody, there was a negative tone in the market as far as production is concerned. Before the report, there was a negative tone all summer. You had some areas in our biggest producing state of Iowa that didn't have a great summer. So everybody thought, oh, okay, by the end of the year, this will all clean out. Well, by the end of the year, guess what? Illinois, Indiana, and almost Ohio, and we knew the East was going to be good, out-yielded Iowa. The bottom line is that, supply is, you have a record corn crop this year, you have a record yield. I think what's kind of scaring the market is, where do you go from here now? Right? You didn't have ideal weather this year. And, I have this conversation with some Wall Street analysts sometime, and they're like, Pete, we just don't get it. The yields in corn are kind of flat. They're at 175, 176, 174, 173. It's been kind of flat the last 4 or 5 years. Yeah, you haven't had a really good year weather-wise. Right. But my point here is that if we close out last year 177 and change, let's say, I think what scares the market is a little bit is, where are you going to start next year? You have to start next year over 180.
Yep.
So, and on the demand side, they made some change in order to offset some of this increased supply. They definitely made changes on the demand side, but only domestically. So, when you look at it year over year, we're up 1.7 billion bushels in corn supply, and we're up 860 million bushels in corn demand. Now, typically, Paul, that correlation is much, much wider. It's only 50% now. And I think what the USDA is telling you there is that they're a little bit nervous about exports. So they definitely made some domestic changes to demand to kind of help ease the pain, so to speak. The carryout didn't really move that much. But as far as the exports return, it's the same thing in soybeans. Soybeans, they made no change at all to any of the demand segments. Basically, you increase your yield. There were some acreage changes a little bit less harvested acres for soybeans, a little bit less corn planted acres. But at the end of the day, you increase soybean supply by like 31 or 32 million bushels, and it went straight to the bottom line. Yeah, that's not to say we're flush in beans, but, so, yeah, the market, the market's interesting. I don't think I would have expected that big of a flush, but it came back pretty good towards the end of the day, and I think it's just because there's a real sense of apathy here as far as the funds and the financial players. They just don't want to get involved. I was at a conference the last couple of days with a few of them, and the CPI came out Thursday at 3.3%. Last year at this time it was almost double that. There's no inflation play here on the commodity side. We saw it again with crude oil. Crude oil today too, Paul. We had these U.S. and British attacks overnight. Crude oil's up $2, closes up 50 cents. There's just not a lot of interest in commodities with the inflation rates being what they are.
Yeah. Okay. Let's jump over to Jarod. What would be some of your takeaways from the reports today?
I want to piggyback on Pete's last comment here for a second. I think the belief was that going into the new year, your index buying was going to start kicking in the commodity space, and talk about a big ho-hum to nothing. And albeit that buying very well still could have been happening, but it's too convenient to be able to line those two pieces up. You've got a index buyer that's probably been active for the last 10 calendar days. However, today's report had the highest on-farm stocks of corn in 14 years for the farmer. And I'm in no way, shape, or form trying to go back and talk about what we talked about month after month after month after month. dating all the way back to a year ago, that the farmer has continued to get further behind, further behind, further behind. Now, I'm very hopeful and I'm optimistic that the listeners of this group, ones who follow a Chris Barron and team, is not in this camp.
Yeah,
But
there are a
the
lot of
amount of
farmers out
length
that are.
the amount of length that the US farmer has is troublesome. They are dramatically behind the typical selling pace, an increase on crop size. To Pete's point, our demand is ho-hum at best. And quite frankly, based upon world supply, not just domestic supply, but world supply, we have our work cut out for us to ever really dig ourselves in a foxhole of being the individual to provide supply to the rest of the world. We're so far out of that realm of possibilities today that's not even funny. It requires something dramatic on a dramatic scale outside the US to get ourselves back in the driver's seat of exporting our product. So you have your managed money issues over here, your participation in the market, your speculative positions based upon inflation or recession, whatever camp you want to sit in. But fundamentals always went out. And, you know, I quite frankly, after I saw today's numbers, that was my number one thought. You get all the way through the growing season, all the noise amplified more than we've ever had. Fundamentals went out again. And I am a little afraid that that winning process of fundamentals is only beginning. We still have a ways to go before that actually draws to a close. So to Pete's point as well, when he talked about the yield that we had this year and what that means into the future and what that acreage mix looks like in the future, it's such a hard bet to say that North America, South America, Ukraine, throw in Australia and Russia on the wheat side, and to a lesser extent, the EU, somebody's got to have a crop problem to fix the production versus demand situation that we found ourselves in here for the last 6 months. And frankly, I just don't think that that situation's even close to being done at this point.
That on-farm number is confounding as well to me because you know we always hear when you don't get a good number, oh, we're going to lock the bin door. I don't think you can lock the bin door with interest rates where they are.
Yeah,
you can't.
Yeah,
and it's good. It's just unbelievable to me that they'd be holding on. You know, is it FOMO? I don't know, but it's just. I mean, it gave me. I agree with Jarod. It gave me cause to pause when I saw how big those on-farms are. Now, granted, let's be very honest about it. The on-farm numbers that they put out in the quarterly stocks numbers are the least accurate numbers in that report, right? There's no real reason for a farm to report. But if that's the case, and with interest rates the way they are, and certainly as an analyst, I have the luxury of having 20/10 hindsight. I get that, but
has there been any material change, not just in this report, over the last couple of reports, or maybe the last couple of months, as far as the plan for the farmer coming up versus corn versus beans, as far as what they're going to plant, or has that been pretty well locked in?
I think there's a lot of consensus around that. You know, corn acres will go down by 2 or 3 million acres. I'm not in that camp. I actually think that they're probably, it's a very regional decision at this point. We do hear stories of farmers that even at this point are changing from beans back to corn. Certainly the futures ratio doesn't necessarily favor soybeans, but I get rotation and I get that, and the costs are lower. But, here's the thing. Even if we were to go down, let's say we go down 2 million acres to 93 million, but the yield goes up by four bushel, that's a wash.
Yeah,
right? You're washed there. It may be 100 million bushel swing or something like that. That's a wash there. And the other thing too, Paul, I think that a lot of people were convinced after seeing the social media posts and everything that was out there that Brazil was just going to be an absolute disaster. I'm not saying the USDA has, kind of put their final touches on it. I mean, they brought their core number down 2 to 127, but okay. Let's say you bring it down another 7 to like 120 or something like that. you still have Argentina, which has had a rebound year at 55. So if you could bring our Brazil down to, let's say, 120 in corn and leave Argentina where it is at 55, you're at 175. You're still up 4 million metric tons from last
Yeah.
year. The beans, it's the same thing. You know, oh my God, the Brazilian soy crop, it's a disaster. Okay, they took it down 4 to 157. Let's bring that down to 150. Let's bring that down to 145. I don't care. Argentina's still going to produce 50, and you're still going to be higher than last year's 185.
Yeah, I know. Jarod, you work with a lot of farmers directly. Are you seeing any changes on that planting intention yet?
Oh yeah, every day. More corn, less beans, and even in some situations, less beans, no corn, but it increased cattle grazing.
Okay.
It's just like right now, it's find every single way possible to plant less beans, especially, we talked about this with Chris numerous times as well. Variable cost, easy to track. It's all the other fixed expenses that sneak up on you. And just got a updated budget of about a 7,000 acre Western Iowa farm that this next year is going to go all the way to 6,000 acres of corn and 1,000 acres of beans. And there's others surrounding him that we work with. They're going to be 100% corn. But seed, chemical, fertilizer, written checks, paid for, no questions asked on what that is going to cost. Based upon a 215 and 60, 215 corn, 60 bushel yield expectation and closing prices. It took 28% of a corn crop to pay for the variable expenses. It takes 35% of a soybean crop to pay for those variable expenses. Granted, what Pete said, it is regional. There are definitely pockets, but I think they're smaller than the grand scale of areas that beans actually do pencil better just based upon the yield prospects that individuals have on beans versus corn.
Yeah.
And in our space, when we talk about the risk management aspect and mitigating risk, I cannot afford to go into 2024, let alone 25, and risk losing $100 to $200 an acre on beans just to plan them for a rotation. I have the capability and insurance and hedging and such to manage that risk so much better in the corn space that, again, I'm repeating myself here from previous calls, but the guys that have made the switches to corn and less beans and have been proactive on those marketing decisions and proactive on insurance decisions, you know what today was? The butt kicking that the markets took, it was smiling ear to ear because the farmer's revenue was going up as the market went down.
Yeah.
And that's hopefully the listeners, I think, is catching on to that who cares about what the USDA report was? Care about your own profitability, care about what your cost production is, care about what your yield prospects are, care about what you can insure, and then do something about it from there. And I was glad to get this report behind us because it takes away all this guesswork in the last 90 days of, are we making the right decision for moving forward here? And as markets move away from where we've been in the last 3 months, it's almost, I don't want to say it's ratifying the decisions that we made or didn't make, but it certainly is, or solidifying, I should say. But it's making life easier of budgeting what our situation is going to look like 11, 12 months from now.
Well, and we're getting pretty close to the start of the discovery period for corn and beans, and I'm going to flat out guarantee, now that's not worth anything, Jarod and Pete, but I'm going to flat out guarantee on the corn side it's going to be at least $1 lower than it was last year.
Pretty close.
Yeah. So
if there's one takeaway on that, Paul, South Texas, Southern Alabama, Mississippi, so on and so on, they just finished their insurance averaging period today.
Okay.
And based upon the implied volatility measurement for the last 5 days of the average, if we maintain that average between now and the last 5 days of February, I do think the general North American row crop producer will see their multi-peril insurance premiums, revenue protection, be somewhere 15 to 18% lower on the year.
Yeah, because we haven't had the volatility and a lower price.
Correct. So, now that's wishful thinking. It's going to stay that way, but we hopefully see a situation that my premium goes down, allowing me not only to maintain at least the same coverage I had last year, but maybe spend the same amount of money I did last year and get more coverage.
Right. Right.
Because it goes back to, can we afford to see corn go from 5 to 4? Can we afford to see beans go from 13 to 12 to 11?
Yeah.
That hurts a lot more than putting that premium on a table and seeing corn go back to 6 or 14 on beans.
Right.
And you may lose $1 on the insurance price, but certainly your input costs are way down. Okay, machinery.
So this is where Pete and I can differ.
I
So
can tell
far-
you that I can tell you the crop rent or the cash rent is not down.
No,
So
that's
our
fair.
bean cost is up on the year and our corn cost is down 3%.
The rent, and that's really my point was going to be really that's the only, your machinery costs haven't changed, your rents haven't changed, your seed costs hasn't changed. And when you look down, because you hear these analysts, these Wall Street analysts say, oh, your input price. Okay, potash is down, P&K is down, some of this other stuff is down, but it just doesn't make up for the other stuff. You guys jumped on me too quick there, my friends, but that's okay.
That was my fault.
All right.
Won't be the last time, but one way or another.
Okay.
Well, we're coming to the end of it. Is there any key ending takeaways that you have based on today, or what's the key thing you want to tell the farmer right now?
Well,
I'll start with you, Pete.
I think that on new crop, there seems to be this idea that we're going to get a spring rally. Something's going to happen with the weather. If that does happen, I mean, based on what we see on the global balance sheets in corn, you have to be a seller above $5. You just have to be a seller above $5. I'm sorry, but there'll be no sympathy or empathy for anybody who doesn't sell it. Beans are a little bit tougher for me because I really, I think beans might be a little bit overdone to the downside. But here again, I mean, when you look at the new crop beans are, just hovering over $12. It's hard to sell beans at $12. I totally get that. But, the corn market, I think will reward you if we get a rally in the spring or find out. But right now, the funds aren't going to be in here. I don't really see the thing moving much. The bears, it is wintertime. In theory, the bears could be in hibernation mode. After all the news and everything that happened today, corn closed down 9 cents, beans were down 10, wheat was down 7. Okay, that sucks, but it could have been a lot worse.
Yeah.
And it just didn't.
It started a lot worse. So
it started a lot worse. Yeah, no question about it.
Jared, any final thoughts?
Piggyback up Pete one more time there. Where March corn bounced from happens to be a long-term important price, right around 440. Important in the terms of what the chart has presented over the years. 440 used to be our top side.
Yeah. No.
Now it acted as maybe a very small scotch of a support. I'll believe it when I see it if it turns into a long-term support. Paul, I'm going to lean towards, again, I'm going to give the benefit of the doubt to the listeners, to the group that is a close follower of the AgView Solutions Group. Right now, my number one thing for our client base and any other listeners is make sure you're doing what you can do in your power to keep the money you've earned the last couple of years in front of you. That's your number one job for 2024 right now. Because the opportunities are starting to present themselves left and right. We have been inundated with land deals for the last 2 months, rental and purchase, nonstop, and that is a sign of the times to come.
Yeah.
Keep the money in front of you. Be willing to get your downside price protection in place. And I just think that's the goal for 24. Make some money, increase your working capital or maintain it. And by God, do not let your net worth go down. Because if I had to have that conversation with a few, you've got this inventory of physical grain or production you're going to have, and you've got this massive accumulation of wealth from land. You can't afford, and you don't want to have happen both of those go against you.
Yeah.
Because if grains decline and land follows it, you're left holding the bag twice. Please do something about one of them.
I'm gonna now piggyback on Jarod there and just say this. If we've lost the export market for both, what that leaves is domestic demand. We don't see much in the cattle markets or the protein markets, but we do still see the fuel markets, right? So the fact of the matter is for 2024, you can raise the enterprise value of your farm and thus your land by focusing on your carbon intensity score, because your crops, your carbon intensity score for your farm is going to make your crops more valuable. That may put a little bit more money in your pocket, but it's going to add to the enterprise value to your operation. And as Jarod suggests, also going to keep your land values higher. Now, we're going to have a lot more to say about this as the year goes on, but I just wanted to leave that at the end there, Paul.
Yeah, especially
Pete,
since
we're
I'm
gonna
a
have a good conversation about that here in a couple of weeks at the AgView conference together, aren't we?
yeah,
Yes, we are.
well, you good old Section 45Z coming up,
right.
and being a CPA, I know enough about that to be dangerous. So, and you're right. I mean, there is now we need to have the IRS come out with some announcements and so on.
Yeah.
But that'll be a separate discussion, a separate call. So again, Jarod, Pete, thanks for taking time out of your day to be on the weekly let's see, the AgView Pitch Weekly Market Outlook. I'll get it correct. So again, this is Paul Neefer signing off. And again, Pete and Jarod, thanks a lot.
Thanks, Paul.